Welcome, investors, to a targeted analysis of SOFI technologies. This isn't just another fintech, it's a full-stack digital bank aiming to revolutionize how consumers manage their money. We're breaking down their latest financial performance, ambitious growth strategy, and the key risks and rewards for your investment, especially with critical Q2 earnings just weeks away on July 29. SOFI's Q1 2025 earnings painted a picture of accelerated growth and disciplined execution. They reported $771 million in adjusted net revenue, up 33% year-over-year, their highest growth rate in 5 quarters. This momentum is powered by their financial services segment, which doubled its revenue. SOFI achieved its 6th consecutive quarter of GAAP profitability, posting $71 million in net income, or $0.06 per share. Crucially, member and product growth remained robust. SOFI added a record 800,000 new members, pushing the total to over 10.9 million, and 1.2 million new products, now totaling nearly 16 million. Their bank charter is a massive differentiator, allowing them to fund loans with low-cost member deposits, saving an estimated $515 million annually in interest expenses. And with a fresh $350 million equity raise in June, SOFI now commands over $575 million in cash, providing ample runway for future investment. Looking ahead, SOFI's strategy is clear: diversify and expand. They've raised their 2025 guidance, projecting adjusted net revenue between $3.23 billion and $3.31 billion, and adjusted EPS of 0.28. Their financial services productivity loop effectively cross-sells services, boosting member lifetime value. They're expanding into high-margin areas like alternative investments, offering access to funds with companies like OpenAI and SpaceX, and re-entering the crypto market. Most significantly, a new U.S. bill, the OBBBA, could privatize a $14 billion annual federal student loan market, creating a massive tailwind for SOFI's private lending business. JP Morgan estimates every 10% market share could yield $70 million in new fees and $200 million in interest income annually. Now for the investor's perspective on risks. First, valuation. SOFI trades at a high premium, with a price-to-sales ratio over 260x and a PE ratio near 49x. A lot of future growth is already priced in. Some analysts, like KBW, maintain an underperform rating, and Zacks currently has a sell rank, reflecting caution. Second, competition and macro headwinds. The fintech space is crowded, and SOFI faces both traditional banks and nimble startups. Economic slowdowns or sustained high interest rates could impact loan demand and credit quality, despite recent improvements. Third, dilution. While necessary, recent equity raises have increased share count, diluting existing shareholders. The opportunity, however, is substantial. SOFI is executing well on its comprehensive bank-chartered strategy. Its low cost of funds, sticky ecosystem, and major new market opportunities, particularly in student lending, position it for significant long-term growth. Analysts hold a moderate buy consensus with price targets around $14 to $16, though it's currently trading above some of these. For growth-oriented investors comfortable with volatility, SOFI remains a compelling accumulate or hold. Keep a close eye on their Q2 earnings call on July 29th for the next crucial update.